No one expected the world's most sophisticated financial system to melt down in just a few minutes. Investors assumed that the stock market, protected by layers of regulation, expert traders, and cutting-edge technology, was too advanced, too fortified, too modern to simply lose control. But on May 6, 2010, in the middle of an ordinary afternoon, something impossible happened. The market didn't crash over weeks or months. It didn't collapse because of a recession or a war. It crashed because of a misunderstanding between machines. Billions of dollars vanished in minutes. Blue-chip companies briefly fell to just a few cents, and for a terrifying moment, the most powerful financial market on Earth looked like a glitching video game. And here's the mystery. The deeper investigators dug, the more they realized that the crisis wasn't caused by a single mistake. It was something far more unsettling, an invisible ecosystem of autonomous algorithms competing, reacting, and spiraling in ways no human could follow in real time. It was the moment when Wall Street learned that it no longer truly controlled the machine. To understand how we got here, you have to go back long before the flash crash itself, back to a period when speed became the ultimate currency. For decades, traders relied on instinct, phone calls, and human judgment. But in the early 2000s, something began to change. A new form of trading, high-frequency trading, or HFT, emerged. It promised an impossible advantage: the ability to exploit microscopic price changes in milliseconds, faster than any human could blink. Firms buried fiber optic cables under mountains, built data centers next to stock exchanges, and spent hundreds of millions to shave off microseconds. The market stopped being a battlefield of human intellect and became a contest of algorithmic reaction times. But this new world came with an invisible risk. The more automated the system became, the more interdependent the algorithms grew. They watched each other, copied each other, predicted each other, and sometimes without any human input, amplified each other's mistakes. Like a highly connected ecosystem, the smallest disturbance could cascade into chaos. By 2010, the stage was set. The market looked normal from the outside, but beneath the surface, it had transformed into something fragile. Liquidity, the number of willing buyers and sellers, seemed deep and stable, but much of that liquidity came from algorithms that could disappear instantly with the right shock. All it would take was one unusual order, one unexpected move, or one miscommunication between trading bots to trigger something no one had seen before. And on that spring afternoon, that shock arrived. Just after 2:30 in the afternoon, with the market already jittery from worries about European debt, a single, massive sell order entered the system. A mutual fund wanted to sell 75,000 E-mini S&P 500 futures contracts, an amount worth roughly $4.1 billion. The fund used an automated algorithm to execute the trade. The algorithm had one simple instruction: sell as quickly as possible, regardless of price, but in proportion to the market's overall trading volume. It was a harmless strategy on paper, one used by many funds. But this particular algorithm had no limit, no brakes, and no sensitivity to market conditions. It treated a panicking market the same as a calm one. In essence, it poured gasoline into a room already filling with smoke. Almost instantly, high-frequency trading firms reacted. Their algorithms saw the large sell order and did what they were programmed to do. They tried to profit from it. They bought contracts from the fund's algorithm and then immediately sold them to other traders. But as the selling intensified and prices began to fall, their bots started to back away. Liquidity evaporated. And here's where the real danger began. The algorithms began trading among themselves at incredible speed, passing contracts back and forth in a feedback loop that inflated trading volume but contributed almost nothing to price stability. The mutual fund's algorithm interpreted this skyrocketing volume as a sign of high liquidity, and so it accelerated its selling, dumping even more contracts into the market. It was a vicious, self-reinforcing cycle, a loop so fast and so complex that no human could intervene. Within minutes, the Dow Jones Industrial Average plunged almost 1,000 points, nearly 9%, one of the largest intraday drops in history. Companies like Procter & Gamble suddenly lost a third of their value. Shares of Accenture momentarily traded for just 1 cent. Retail investors watching from home thought it was a glitch. Professional traders on Wall Street were frozen in disbelief. Some firms stopped answering phones. Others assumed they were under cyber attack. Meanwhile, the algorithms continued executing trades at lightning speed, oblivious to the panic they were causing. What made the flash crash especially terrifying was that it didn't resemble a traditional financial crisis. There were no shocking headlines, no major bankruptcies, no policy mistakes, no huge scandals, just an unexpected cascade of machine-driven decisions that spiraled so quickly that the market briefly detached from reality. Human traders tried to step in and correct prices, but they were overwhelmed. Many simply pulled their orders, leaving the machines to fight among themselves. For a brief and chilling moment, the world saw what a fully automated financial accident looked like. Then, just as quickly as the market collapsed, it rebounded. Within 15 minutes, most stocks had returned to near normal levels. Billions in market value evaporated and then reappeared. But the damage was already done. Public trust was shaken. Lawmakers demanded answers, and regulators faced a troubling question. If algorithms could accidentally wipe out nearly $1 trillion in minutes, what would happen during a real crisis? Investigators from the SEC and the CFTC launched a joint inquiry, and what they found was more disturbing than any single explanation. There was no hack, no fraud, no fat finger typo. The crash wasn't caused by one villain. It was caused by the structure of the modern market itself. The combination of fragmented exchanges, hyper-fast automated trading, and aggressive algorithms created a system that could destabilize without warning. Even more unsettling, regulators discovered that during the crash, high-frequency algorithms didn't act as stabilizers. Many of them acted as accelerators. They pulled liquidity when the market needed it most, deepening the plunge. The investigation also led to an unexpected twist. A London-based day trader named Navinder Singh Sarao had been layering spoof orders, fake buy and sell orders to manipulate futures prices. His actions did contribute to instability, but despite sensational headlines, experts agreed that his spoofing did not cause the flash crash. At most, it made a fragile system slightly more fragile. The real cause was systemic. Algorithms reacting to algorithms in a loop no one had designed, predicted, or understood. In the months after the crash, regulators introduced new tools to prevent similar events. They added circuit breakers, automatic pauses that stopped trading when prices moved too quickly. They implemented new rules for high-frequency trading firms. They improved data reporting and enhanced market surveillance. These fixes were meant to reassure investors that the market could never lose control like that again. But beneath the surface, many experts felt uneasy because the deeper truth was this: the flash crash wasn't a one-time event, it was a preview. Over the next decade, the financial system became even more automated. Algorithmic trading grew from about half of all trades to nearly 3/4. Machine learning-based strategies began making predictions based on patterns no human could see. Dark pools, private exchanges where large trades happen out of public view expanded, and the stock market continued accelerating, growing more interconnected and more dependent on machine logic. Meanwhile, mini flash crashes, smaller, localized price collapses started happening more frequently. Shares of individual companies would suddenly plunge for a few seconds before bouncing back. Sometimes, these events were barely noticed. Sometimes, they erased millions of dollars in an instant. The pattern was unmistakable. Complexity was increasing, but transparency was not. And this raises the unsettling parallel to today's world. We now live in an economy where AI systems, not humans, make a large portion of trading decisions. In the early 2020s alone, algorithmic strategies were responsible for more than 70% of U.S. equity volume. Market-making algorithms now execute thousands of trades per second. And as artificial intelligence systems evolve, they're beginning to learn from each other in unpredictable ways. The same conditions that created the flash crash still exist, but now the algorithms are faster, smarter, and often more opaque. If a single flawed instruction in 2010 could trigger a trillion-dollar collapse in minutes, what could advanced AI systems do today during a geopolitical crisis, a sudden inflation shock, or a major corporate bankruptcy? The feedback loops are still there. The hidden interdependencies are still there. And the illusion of liquidity deep on the surface, shallow underneath, is still there. There's another warning in the data. Studies show that liquidity in modern markets can vanish up to 60% faster than it did a decade ago. Market depth, the number of orders resting in the system, has thinned as algorithms favor speed over stability. And during times of stress, high-frequency trading firms now routinely pull back, just as they did in 2010. The message is clear. The next flash crash may not look like the last one, but the conditions for another sudden collapse are stronger than ever. And so we're left with 3 takeaways. First, speed does not equal stability. The market may be faster today, but it is not safer. Second, complexity creates fragility. The more we automate financial decisions, the more unpredictable the system becomes. And third, algorithms are powerful, but they are not infallible. A single instruction, a sudden surge in volume, or an unexpected reaction between automated systems can trigger consequences no human can stop in time. As financial markets become more automated, we're forced to confront a difficult question. Who is really in control? The traders? The regulators? Or the algorithms that now shape the global economy? The flash crash of 2010 wasn't just a historical anomaly, it was an early warning. A glimpse of a future where machines act faster than we can think, and where small mistakes can become global shocks. If you want more deep dive stories that uncover the hidden forces shaping the financial world, make sure to like this video, subscribe to the channel, and turn on notifications. There are more mysteries to explore, more lessons to uncover, and more financial events that still influence the world today, whether we realize it or not.